This week, the market faced a war scare on Monday and ended Friday at all-time highs. 5 trading days, a complete narrative arc, and a few signals worth knowing about under the surface that most coverage missed. Here's the week that was. Let's start where it started. Monday morning, Iran launched missiles at the United Arab Emirates. The Dow lost 557 points. The S&P 500 fell 0.4%. Oil spiked over 4%. Cyclical stocks got crushed. The view that morning was simple. War in the Middle East. Oil supply at risk. Sell stocks. Then Tuesday happened. The US and Iran ceasefire that looked broken Monday turned out to hold. Oil reversed almost 4%. The Dow recovered 356 of those lost points. The S&P 500 hit a fresh all-time high. Tuesday's lesson seemed straightforward. Monday was a panic. Buy the dip. Wednesday took it further. Reports surfaced that the US and Iran were close to a one-page memorandum of understanding. Oil collapsed 7%. The Dow gained another 612 points. The S&P 500 and Nasdaq both hit records again. We called it the peace trade. 3 days, 3 different stories, but one trend: up. Thursday paused the rally. The Dow lost 313 points after briefly crossing 50,000 intraday for the first time since February. Chip stocks finally took a day off after weeks of leadership. We called it the breather. Whether it was a one-day pause or something bigger was Thursday's question. Friday answered it. The April jobs report came in dramatically stronger than expected. 115,000 jobs added against expectations for 65,000. The S&P 500 closed at a new record. The Nasdaq broke 26,000 for the first time. 6 straight winning weeks for both indexes. The longest streak since 2024. That's the week as it happened. Now here's the week as it actually was. The market made a choice this week. It chose to focus on what it wanted to see. And what it wanted to see was strength. Strong earnings. Strong jobs. Strong AI demand. Records on records. What it chose not to see was just as important. It didn't see direct strikes between US and Iranian forces in the Persian Gulf on Friday. It didn't see Iran's failure to formally respond to the 14-point peace proposal. It didn't see the unit labor cost data that came in 2.3% against expectations of 1.6%, suggesting wage inflation is still running hot. It didn't see the S&P 500's RSI climb above 70, the technical level traders use to flag overbought conditions. It didn't see the Dow transports continue their divergence from the broader market, down more than 20% from their April peak. And on Friday, it didn't see the Dow finish basically flat, while the Nasdaq ripped 1.7%. The largest single-day divergence in months. We covered 4 warning signals across this week's videos. Treasury yields rose despite risk-off sentiment on Monday. The Dow transports diverged on Tuesday. The RSI moved overbought on Wednesday. Wage cost growth came in hot on Thursday. Add Friday's Dow versus Nasdaq divergence and the strengthening hawkish Fed narrative, and you have something. Not a top, not a prediction, just signals. 5 different signals from 5 different corners of the market and economy, all pointing the same direction. The trend is up. The structural pressures underneath are building. So what does this mean heading into next week? 3 things to watch. 1. Whether oil bounces hard Monday morning on Iran escalation over the weekend. The peace trade is unwinding quietly, even as markets rally. If Iran responds aggressively, we could see Monday of last week play out again. 2. Whether the Federal Reserve commentary turns hawkish. The dovish wing lost their core argument when Friday's jobs report came in this strong. Any Fed governor speeches in the coming week could move bond yields if the language shifts. And the FOMC minutes from the April 29th meeting released the week after next, which will reveal the detailed discussion behind that 8-4 dissent split. The bond market reacts to all of that before stocks do. 3. Whether tech leadership keeps narrowing or breadth improves. Friday's divergence was the cleanest illustration we've had of the AI concentration risk. The narrower the leadership, the more fragile the broader market. The week ended with new records. Whether next week extends them, or whether this is the level where the warning signals start to matter, is what we'll find out. This is the week that was. We cover the days the markets actually move, typically a few times a week, more when things get wild. Hit subscribe so you don't miss it. We'll see you next time.